You know you can buy just about anything at Costco. That now includes gold. Costco is now selling 1-ounce gold bars. They're already selling out fast across the country.
Think you could guess the value of this?
3,500.
Jeweler said max too small.
85.
Too small.
This is the serious behind-the-scenes look on what's actually going to happen.
1,000 because it's probably not pure.
100,000. 300.
Like 400, 250,000. It's a heavy-ass bar, man.
350.
We walked in with a bunch of dust.
Put that around your neck in a pendant like this big.
An enduring emblem of opulence and affluence, has seen a resurgence in favor, notably among the wealthy, particularly in Miami and New York. This revival captivates my interest. Despite my personal disinterest in gold, many of my contemporaries, part of my generation, seem similarly indifferent to gold, as they increasingly gravitate towards cryptocurrencies like Bitcoin, viewing it as the modern-day equivalent of gold. My own investment portfolio has rarely featured gold, but the fervor surrounding it has prompted me to delve into the data and assess whether this precious metal truly warrants the attention it receives. Before we dismiss gold as a suboptimal investment choice, let's examine some intriguing statistics I uncovered during my research.
Speaking of money, listen to this. Costco says it can't keep one item in stock. Big box retailers selling 1-ounce gold bars online for more than $1,900.
Now you can
In the past year, I was surprised to discover that gold had shown significant growth of 15%. Initially, I assumed that the stock market, as represented by the S&P 500 index and measured through an ETF called VU, would have at least matched or possibly exceeded this performance. However, to my amazement, the S&P 500 only recorded a 12% increase during the same period. Thus, we find ourselves in an intriguing situation where gold has outperformed the stock market over the past year. This performance can partially be attributed to concerns about inflation. As the Federal Reserve expanded its balance sheet, it led to an increase in inflation, as many had predicted. In response to this potential erosion of their purchasing power, people turned to gold as a hedge. While this reasoning holds merit, it doesn't tell the whole story, as inflation is a relatively recent concern. To gain a more comprehensive understanding, I decided to scrutinize gold's price trajectory before the Federal Reserve injected a staggering $4 trillion into the economy. Upon zooming out to view a longer 5-year time span, I uncovered some compelling insights. Back in 2018, the spot price of gold stood at $1,200 per ounce. However, over the subsequent 5 years, it ascended to an impressive $1,820 per ounce, signifying a remarkable price growth of 51.2%. This is an exceptionally promising return. Let's contrast this with the stock market's performance over the same 5-year period. During this time, the S&P 500 index rose from 2,920 to 4,258 points, translating to a growth of almost 46%. While this is undoubtedly commendable, it falls short of the astounding 51.2% growth exhibited by gold. As someone predominantly invested in the stock market, I was taken aback by this revelation. How could gold outshine stocks? Does gold, then, constitute a superior investment compared to the stock market? These are questions that beg contemplation. If I had gold to sell, I might be tempted to assert its superiority and encourage you to buy my gold, my precious, before mysteriously vanishing. However, the unvarnished truth is that despite its impressive performance, gold hasn't proven itself as a superior investment to stocks over the last 5 years, and there's a compelling explanation for this. The charts you typically encounter when perusing stock market performance frequently overlook a critical component I affectionately refer to as big dividend energy, or BDEs. They often omit the significance of dividends in the overall returns. Dividends, which represent the income generated by holding certain stocks, are not universally reinvested by investors. Some opt to utilize these dividends to cover expenses or fund their retirement, rendering it impractical to assume universal reinvestment. However, to compute the total overall return, dividends must be factored in. This necessitates examining a separate ETF, namely the S&P Total Return ETF, symbolized by SPTR, or perhaps pronounced SPTR. To grasp the impact of reinvested dividends, we revisited the same 5-year time frame. Here's what transpired. Commencing in October 2018, the index stood at 5,708 points. Fast forward 5 years, and it now hovers around 9,184 points, signifying a robust growth of nearly 61%. This performance not only surpasses gold's return of 51.2%, but also underscores the power of reinvested dividends in augmenting returns. Reinvesting dividends incrementally increases the number of shares held, akin to a dollar making another dollar, and this compounding effect can be formidable. In contrast, gold remains static in quantity over time, as it doesn't offer dividends,